TheoTrade. This is Don Kaufman. January 13th, 2023. The market grind to the upside goes on. All right, on this weekend's update, we're going to be discussing an indecisive market at an inflection point. What does that really break down to? It breaks down to a marketplace that took off to the upside a bit on Wednesday, but it's really been a grind. You know, we saw some heavy option volume both on Wednesday, that was before the CPI number, and of course on Thursday we did like 52 million option contracts on Thursday to get absolutely nowhere. I have to tell you, and I think I speak on behalf of all traders, boy, that CPI was a disappointment. Come on, you're either going to have a CPI that came out a little bit hot or a CPI that came out a little soft. Instead, we hit the numbers we were expecting. Oh, whoever thought we'd actually hit what the economists were actually expecting? Anyway, with that, let's get right down to business, because there is this feeling right now of, yeah, it's a rally, but to me, it's much more about its indecision. It really is an indecisive marketplace, and you can kind of feel that we're at an inflection point, and that's exactly what I'm going to explain here on this update. First and foremost, let's get right down to it and talk a little bit about levels, specifically inside of the S&P. So pretty evident, hey, we closed at what, 40.19. Does that have any significance? No, not really. I mean, it just doesn't. When you start looking at this, though, on a 30-day 1 hour, by the way, I like to pull up, when I pull up S&P futures and want to show a little bit of a broader time frame, I forget the daily, I really do like that kind of like 30-day 1 hour, because it exemplifies, for instance, oh, that was just, you know, Mr. Toad's wild ride in there in terms of a volatility box. So the volatility box now has ultimately resolved itself to the upside. But some of the upside trade is kind of listlessly to the upside. And it feels like there's just no commitment on the buy side. There's some short covering, some people possibly stepping. And by the way, if I hear one more person talk about, it's the fear of missing out. Really? So you're in the beginning of 2023. You just saw people get decimated in 22. Is there really going to be a fear of missing out? I just don't buy into it. Okay, people now, all we're talking about is a recession. I mean, it's some of the most bearish, you know, rhetoric I've heard out there, I think ever. Like, everybody's on the bear side, and here we are yet grinding to the upside. But the first thing I want to point out is something we talked about on, extensively, and that is, the levels that we provided on last week's update, we've just been spot on with that, and that's right here, okay? Whether I like it or not, look, people understand I carry bearish positions. But that is a much longer term bearish. Short term, I talked about specifically, and I'm actually going to put it up here, the 39.31. So if you will, right there, that's 39.31. And we talked about, especially if we actually got decent amount above 39.31, it's kind of, 39.31, and away we go. And that's precisely what we did. But I do have to say, we've had some short-term pullbacks in here, right around this like 39.60. If you want to be really specific, it's 39.68. Come back down to that 39.68 and there's a big question mark right at that level. And I'm serious about this. 39.68, watch it this next week in trade. And you go, well, this next week in trade, come on, Dom, we're already trading 40.20. We're not getting back down there. Yeah, but there's a pretty good chance we will be back down there. So be aware. There's been it's just kind of an inflection point in trade right now. And again, so we've taken off to the upside, at least at this point. But as I said, there's just not a lot of commitment up there. It feels like some short covering. We get a little bit of a gamma squeeze, and away we go. Right? I would like to say that there's a lot of buy side activity, but everything feels very tentative, very hesitant. Like, there's nobody coming in right now and they go, I just got to buy Apple. This looks like, a quintessential rip your face off rally. If you look at the entire market structure right now and the rally that we've seen, right? So the rally that we saw, to me, and again, with all due respect, the rally doesn't even really grip hold until we got above like that 3,900, because lo and behold, and again, I'll go back to that 30-day look. And in that 30-day look, when I say the rally didn't even grip hold to above 3,900, look, we're just channeling back and forth inside of the box. So the rally grips hold. We're maybe up about 100 handles in the S&Ps. That's it. That's the entire rally. Now, you put yourself in check for a second. What really caused that rally? All right. And what really caused that rally is the quintessential, like, rip your face off rally, just short covering in a handful of products, in my estimation. Okay. And these are products that have just been beaten down and bludgeoned. I'm bringing up like NVIDIA. Obviously, we can bring up Tesla. Tesla, the bounce was very, very meager, but even today came back quite considerably. When you start looking, though, at the products that are really ripping in terms of a bounce, look at Microsoft. It's the beginning of the year. Okay. I mean, that's, again, it's kind of that quintessential rip your face off rally. A lot of these stocks are actually going to face earnings. Maybe not this next week, but the week after that. Coming into the week, of course, of this obviously here is Microsoft's January 24th. You look at Apple, it's had that strategic kind of rip your face off rally. You even look at something like Amazon, which got decimated last year. Okay, huge rip your face off rally. And right there, just to put it in context, that's pretty much what caused the S&Ps to progress to the upside. Now, meanwhile, at the same time, if you do take a look at the financials, okay, which I'm obviously going to cover because they had earnings today. Before I get to the XLF, because the financials, they eked out gains, but do earnings even matter? Because if you saw the financials today, take a look, for example, at JP Morgan, right? There was actually not very much positive on this front, but I think Jamie Dimon is actually shaking his head and throwing his hands up in the air as much as anybody. When you look at this, the stock is actually ending up today by 2.5%. You go, well, what happened? The earnings were not so good. You look at something like Wells Fargo. Okay, Wells Fargo is still shaking their head right now. They go, yeah, we pretty much diminished our mortgage division, which is like our biggest division. We're not really doing very well, but it's okay. We're going to rally right now. It didn't matter. It didn't matter. Sometimes order flow just jumps ahead of it, okay, and away we go. And that's exactly what we saw in here. There's some short covering, okay? I mean, no one is going to convince me in any uncertain terms. No one's going to convince me that, yeah, I really had to buy JP Morgan today on some crappy earnings, okay? These are evidence of more and more gamma squeezes, okay? And it's not like somebody's coming in here necessarily to buy for an investment. They're buying stock to actually hedge off, okay, directional risk they're incurring. So you start to get a little bit of buy-side activity, and that little bit of buy-side activity spirals us, especially when you start to see very linear moves like this. It just reeks of algorithms buying. Why do they buy? Okay, the algorithms buy to actually hedge off negative delta. How do you hedge negative delta? By adding positive delta. How do you add positive delta? By buying the shares of the stock. Okay, why? Starts with a little short covering, okay, turns into a full-blown gamma rally, and then, we just kind of petered out. But again, it's pretty unusual because the financials, I say, eke out gains. Some of the earnings there were questionable. So I ask, do earnings even matter? And the answer to that is, and I'll give you my feeling on it, they do. Those earnings are going to matter, especially when it starts to come to tech companies. Because if tech starts to show, especially tech companies that are involved in advertising, your Googles, okay, that's your Metas, the artists formerly known as Facebook. It's really going to make a difference. It's going to make a huge difference. And you also have to question stocks like of course, Microsoft, which just got pummeled into the front of the year. A wicked rip your face off rally. But again, those earnings are right around the corner. A lot is going to be relinquished. But there's just a big question mark in this inflection point and indecision out there. So the other aspect that really kind of resonated with me in the midst of all of this, and you feel like you're just in this slop fest of a marketplace, right? Except we hit the edge of the expected move. And one of the things I really wanted to point out, okay, in the midst of this big slop fest, you realize that the edge of the expected move, I'm zooming in literally to it, the edge of the expected move was 39.93 and change. I mean, it's right there on your screen, 39.93 and half, okay? Actual closing price, 39.999. Okay, so you have this, it's just amazing, if you will, efficiency in this marketplace to where, I mean, it's ridiculous. You have a $4,000 product, okay, that early in the week says it's supposed to move $98. That was the expected move. And I'll even cruise down to the SPX here for a second because the market was supposed to move $98.31. Actual move, I mean, if you played pin the tail on the donkey, you couldn't have hit it this good. It's insane how efficient you can be. So is this really a breach? I highlighted it, but is this really a breach of expected move? To me, absolutely unequivocally not. I mean, when the edge of the expected move is 39.93 and you actually close at 39.999, okay, it's ridiculous. It's efficient and it's perfect. And yesterday, the rally even petered out on the edge of the expected move. And I wanted to show you that because as I say, in the midst of chaos, in the midst of what feels like indecision and so forth, you realize one critical aspect. And this is why I am displaying it week in and week out. All right. What's the critical aspect? Okay. It's not some wild randomness. And moreover, it's the options marketplace that's actually driving flow. If it wasn't the options marketplace, why would the SPX close literally on the edge of the expected move? Okay, I mean to a T. How many times, all right, in this chart? And again, I'm not a market technician. I'm quantitative. I'm a quantitative individual. Look how many times in this chart, like the absolute low of a trading session is the lower edge of an expected move. The absolute top of a trading session is the upper edge of the expected move. The absolute low, I mean, you know how many times you can actually point that out? It's because that's where gamma goes to die. That's where actually the directional risk ceases to exist. And I'm telling you, okay, there is this incredible degree of efficiency in a marketplace. It's got all this indecision. You realize that indecision, all right, can be summed up in like, look, the SPX didn't trade like some massive volume today. It did about 2.4 million contracts. Then you look at the spiders. Spiders are good for like 7 million contracts. But if you just added up the spiders plus the SPX, in terms of option contracts, you realize you did over 10 million contracts. There were a little VIX in there because VIX is, of course, based on the SPX. That's good for another million. It's like a third of all volume, 1/3 of like all volume in the entire market is basically SPX. And it's incredible because that's why you get that kind of efficiency in the marketplace. By the way, if a third of all the option volume is in the SPX, but the SPX is a $4,000 product, which is like 20 times the size of any other product, you realize like 70%, okay, of the notional value, which is the actual equivalency of how much capital is being traded through a marketplace, like 70% is all about SPX and spiders, which are basically the same product. So on the edge of expected moves. And what I'm getting at is in the middle of all this indecision, in the middle of all of these inflection points, okay, you can find a little bit of salvation in the fact that those expected moves, okay, are spot on. Now, let's actually come to the next question. Is the market stalling out? All right. When I say is the market stalling out, did the marketplace rally up, okay, and just effectively stall out because it hit the edge of the expected move? My answer to you is absolutely unequivocally yes, we did. We stalled out because we hit the upper edge of the expected move. Okay. This is, to me, this rally this week, to me, is much less about market forces wanting to buy. And it's much more about, hey, look, there was just a crap load of gamma risk. And there was a reason there was a crap load of gamma risk. There was a CPI report. The CPI report, nothing happened. It wasn't good or bad. We came out as expected because nothing happened. We ultimately just kind of continued the grind. A dull market is usually a bullish market, and that's exactly what we saw. But at the exact same time, of course, everybody's going to point out, look at the VIX. In fact, it is important to pull up the VIX. Let's actually pull up the VIX as the market's kind of stalling out. In fact, I'm even going to open up a 3-year in the VIX because I think it's imperative to see this. We are now at one of the lowest levels that we've been in terms of volatility. Okay, forget about 2023. Obviously, we're at the lowest volatility of 2023. The year just started, but we're basically at the lowest volatility we've seen since the very beginning of 2022. Why is that important? Because do not look at the VIX. This is where I'm going to go nuts. Don't look at the VIX right now and try to construe whether you're going to be bullish or bearish. I think there's times like earlier this week, okay, that you possibly could have looked at that, but don't look at it and think bullish or bearish because the VIX is low. All right. Look, at this point in time, the one thing you have to kind of rationalize is now I'm going to go to 180-day 4-hour. Right. And the reason I'm going there is it's like, look, people, we're at 4,000. We have been here before. We have been here so many times that it's boring. You know why the VIX is so low? Because we've been here so many times that it's boring. Why is the VIX low? Because it's boring. It has nothing to do with whether you want to be bullish or bearish. This is a boring place. Okay, we've been to this neighborhood before. We're not getting killed in this neighborhood. We're doing fairly good until we got all the way back down. Okay, you'd have to get all the way down to the bottom of 3,800 before that VIX was really rocking. So, hey, understand that volatility ain't exactly rocking. Like the markets can make big moves, but don't look for VIX to take off necessarily to the upside unless markets get downright hostile. Okay. And right now, I don't mind saying we are at an inflection point, and to perpetuate any more of an up move, and here's some really critical points. If you start to perpetuate any more of an up move, people, it is a clean shot. And I'm the first to tell you, into the 42.11. 42.11, okay, can happen. And you look at this and you go, but everybody's so bearish. Like, forget about what everybody else is. All right. Forget about the fact that there's even an economy out there. Right now, you got forces of gamma that'll drive us. If we head just a little bit higher, okay, you're going to get squeezed right up into it. There's just no question. Listen, we're almost more than halfway home to it. But at the exact same time, the easier scenario, and again, if I wanted to assign probabilities to this, the easier scenario is to revert right back down to the 39.31. And as painful as that may be for some people, it's an easier scenario coming into some of the bigger earnings announcements, because markets love to gravitate towards warm, fuzzy places. It couldn't be more warm and fuzzy at 39.31. And there are some very large earnings announcements coming out. Okay, obviously, this next week there's going to be some more of the financials. You'll even hear the likes, I believe, of like Netflix. None of the really big tech stocks are coming out. Things start to get really interesting though the week after. I'm throwing Tesla up there for a second, and Microsoft, obviously. Okay, and the granddaddy of them all, which is Apple, does not come out until like early February. But push all that aside. There's still enough earnings to actually cause some strategic moves in the marketplace, and as such, a pullback into the 39.31. I mean, come on, this is not just well-charted territory. You'd pretty much be sick of this level right now. But to me, that is unequivocally the higher of the probabilities at this point, with a marketplace that does feel like it's stalling out. The marketplace does feel like it's stagnating. Don't look at volatility and think anything of it. The other aspect that really resonates with me, I wouldn't be surprised to see bonds back off a little bit, maybe interest rates pop back up. Again, everybody wants to talk about the Fed, but the Fed, great. The next Fed meeting comes out, neither here nor there. We also have economic data that's going to continue to kind of rock this marketplace. Don't even worry about the economic data. Just realize when it's coming out, and realize that every time economic data comes out, all they're basically doing is throwing matches at a pool of gasoline. Okay, the one thing that I have to continue to reiterate about this marketplace, even an 18 VIX, okay, it's serious business. And you have a marketplace that's just been pent up with volatility. And even like this CPI print that happened on Thursday morning, it didn't rock the marketplace like anticipated. So there, in my opinion, is some very serious pent up volatility. And we're going to be going into, of course, a 4-day trading week, which again, expect that you can still very well be Mr. Toad's wild ride. People get exhausted, people get tired, volatility wears them out. Okay, we've rebounded a little bit. Get ready for another round. Meaning that get ready for another round of volatility, even if that is construed as upside, movement, and we actually do shoot all the way up to the 42.11. At this point in time, just have respect for the fact that the marketplace doesn't necessarily need positive news to explode higher. It's already got all the gamma risk it needs. The highest probability is right back to the 39.31. Okay, and that's probably the lesser of the evils. All right, hitting all the way up to 42.11. It's going to cause some pain for some people, but again, hands and feet inside of the vehicle, have expectations. A lower probability, but could play out. Let's talk a little bit about get your trade on this week's profit and losses. One of the first things I've done as well, I've covered a lot of stuff. Okay, what have I actually covered? You can see to close. So I've actually covered some short options, nothing too critical. I mean, the week didn't really give me all that many opportunities. I covered some short options here in my TheoTheo portfolio. I covered a couple of short options over here in terms of my TheoTheo small portfolio, meaning I bought back, okay, stuff. In this case, the 3190 puts, I bought those back for over a 50% gain. Okay, it turned around over here in the main TheoTheo portfolio. I bought back the 3100 puts. That one was actually done for over a 50% gain. And I also allocated a couple of new trades over here. So inflection point spreads in the TheoTheo portfolio. You can actually see here is actually a put spread that I purchased as a hedge against a 45, 50, 32.20 strangle. So this is actually what we term the inflection point spread. In addition to it, I did kind of a fun trade where I went out and actually traded in VIX. For those of you unaware of like VIX, I went out 67 days. I'm actually going to open this up and show it for a moment because it's a new trade, right? So get your trade on. It's easy enough to say, hey, look, I'm making 50% here, 50% there, 50% there. But I want to show you the types of trades I'm doing right now. Okay, I wanted to take a shot in VIX. What kind of a shot do I want? I wanted to take a bullish shot in VIX, and I'm going 67 days out. Now, am I indicating that volatility is forthcoming? It could be, but I thought it was actually well worth the shot because today, expressly today, I bought the lowest volatility that anybody's been able to buy in basically over a year. So I was fine with that. If the VIX continues lower, who cares? I got 67 days, but I bought a 24-29 spread. Okay, so I bought a nice little $5 wide spread in here. Okay, and oh, what did you pay for it? Doesn't matter what I paid for it. Okay, I think I paid 82 cents, and I did it a bunch of times, right? So I paid 82 cents for the spread. In fact, let's come over here and go to the account statement. Okay, look at VIX. You can see there's 3 fills in here, but yeah, I know I traded a ton of these. Okay, and then I went out and actually financed that particular trade via having sold, okay, an out of the money put. So I actually sold a 32.90 put, and this is a couple expirations obviously out to finance the trade. And you go, well, why did you do that? Because I'm going to try to collect 50% of this $19.50 to finance 100% of the VIX trade. So if the VIX trade goes out worthless, I don't care because it was totally financed by the fact that I sold a put. But what if the market crashes? If the market crashes, I'm going to make a bunch of money on the VIX trade. I'm going to make a bunch of money on the VIX trade. Am I going to take some losses in the S&Ps? Yes, I will. But the S&P losses, okay, will be more than compensated for by the VIX trade. That, people, is what we actually term Catapult. And if you look at the Catapult portfolio, I'm taking positions in Apple, in Amazon, in Caterpillar, in FXI, in Netflix. Some of them are making money, some of them are losing money. Want to know something interesting about these trades? Every single one of those trades has been 100% financed, okay, by the sale of options in the S&P, options on futures contracts, okay? Every single one of the trades that I have on in here. So if everything went against me, I'm still coming out slightly ahead because I've actually not only sold premium, but I'm making a little bit more in the money in terms of the premium I'm selling than going out there and using it. So for example, I might sell something for $1,000 and I'll take of that $1,000 that I collected for selling premium, I'll take 500 of it and I'll put it to use to buy Amazon spreads or I'll buy Caterpillar spreads. I'm taking shots, people. I'm taking shots. And I'm taking shots by financing it in a particular product. So welcome to Catapult. All right. Last but definitely not least, let's go back to the SPX, the mother of all products. So in the SPX, we just came off of a week. As I said a moment ago, we had about a $98 expected move, right? $98. So we're expecting to move up 98 bucks or down $98, right? And that was, of course, this past week. This next week of trade, we're going to a 4-day trading week. We only have about a $64.78 expected move. So let's just round it. Let's call it a $65 expected move. You're looking for $65 higher, $65 lower. As I said, earlier, kind of feels like things are kind of fizzling out over here. Yeah, don't kid yourself, because one of the things that you have to understand, we're actually going into a primary or a monthly, if you will, expiration inside of the SPX. So there is hideous amounts of open interest in SPX this coming week. So even though there's a relatively, if you will, lower expected move, okay, I think you need to anticipate once again some volatility hitting this marketplace. Look, all right, we're indecisive right now. There's no question. We're at an inflection point. There's no question. Gave you a couple of levels there to actually shoot for, the highest probability being actually trading back to the 39.31. We're all well aware of it. Okay, but in the interim, understand that volatility is far from dead. You need to still be under the notion, okay, that what occurred in 2022 is still very much with us. Okay, the volatility beast, it's just napping right now, but believe me, it's coming back. Thanks everybody for joining us here at TheoTrade. Have a wonderful holiday weekend. Bye-bye.